What's going on, everybody? It's Steve. Welcome to another market update. It's the end of January, February 2nd, actually, to be exact. And I got all the latest details for you about the real estate market. So sit back and relax, and we'll get you all the info here. All right. So to kick off, the first thing I want to do is start with the macroeconomic view. Once we do that, kind of understand what's going on there, we're going to zoom in a little bit and kind of see what's going on with interest rates and how the macroeconomic environment is affecting the interest rate environment. From there, we're going to deep dive into inventory, what kind of supplies coming to the market, the outflow, what kind of sold pressure do we have in the market, what kind of selling pressure we have in the market, fail to sells, and then we'll just look at some lead and lag indicators, such days on market and all that fun stuff, as well as the big monthly average sale price reveal. All right, so if you're all ready to dive in, let's begin with the macroeconomic viewpoint. All right, so looking at the macro, the US inflation reading is going to come out February 14th, and the Canadian inflation readings are coming out February 21st. That's going to be important because if we can continue to see inflation coming down, it's going to give enough reason for the central banks to pause their aggressive rate hike plans. Just recently, the Bank of Canada on January 25th raised interest rates by another 25 basis points, increasing the variable rate mortgage. However, that's the first time they really said we're probably going to do a pause here and see what the recent interest rate hikes did. And that was enough to really send the markets into bond buying mode and putting cash back into the market because the bond yields are continually being driven down. And when the bond yields gets driven down, that's going to put enough pressure on the 5-year fixed rate to drop as well. All right, to put some visuals on it here, as we can see, inflation was 8.1% back in June, and we dropped to 6.3% in December. We're going to do that February reading in March 21st, and that's going to let us know what January is coming in at. If that comes in positive, we can expect more pressure on the bond yields to go down. Let's quickly take a look at the bond yield market here. As you can see, we're currently sitting at 2.9%, and I'll show you what that does to the interest rates. And as you can see, this is kind of where we were when interest rates were a lot lower and how much more room we have to fall. But right around here is when interest rates were around 5.5%, and we've been on a steady decline ever since to where we are now around 4.5%. Okay, so that's what that's all about. Now let's talk about interest rates and how the bond market affects the 5-year fixed and how the Bank of Canada's key lending rate affects the variable rate mortgage. All right, so now I'm going to do a quick rundown of how this affects the interest rate market. And to start, I just want to explain what's going on with how a bank operates it. And I'll start with this word that's called a spread here. So a spread is essentially what the difference is between what a bank can get and then the spread is what they want to charge out to customers. So for example, they get a bank rate of 3% from the central bank and they want a 2% spread, they're going to charge 5% to a customer. However, if the bank rate starts dropping and the spread becomes too high, so say for example, they only want a 2% spread, so if they can get it at 3, they're going to offer 5. But if the bank then drops the rate to 2.5, they're getting too much spread, and to stay competitive with other banks, they drop their rate, have a lower spread. But the banks are all kind of operating around this similar spread threshold. That's why you see most of these banks moving in tandem. Sure, some will offer always a better rate than others, and some are willing to take a smaller spread than others. But that's really just the competitive landscape of how banks are competing against competing for your business. Okay, so they're operating on a spread kind of basis here. And there's two types of spreads that the banks really rely upon. The spread on the 5-year variable, which is usually around the 2% mark. And then the fixed rate, on the bond market, it looks like their threshold is around 1.5%. Why do I know this? Because looking at the last little bit of data here, I can see that every time the bank gets to around a 1% spread on a bond market, so for example, the bond's at 3.3%, and they want a 1.5% spread, then they need to be closer to 4.5% interest rate. So here we see the bond yield market went down to 1.4%, interest rates went up. Again, here is another 1% spread, so the spread got too thin. There goes the interest rates up again. On the flip side, when bond yields started dropping and the spread became too big, banks would start competing, or the lenders would start competing against each other. And as you can see here, when we got to 1.7, we dropped the interest rates. Here we're at 1.8%, drop the interest rates. 1.7 again here, drop the interest rates. I know there's more interest rates drops right here at 1.5, but it's because the bond yield just kept falling so fast that they just kept lowering their interest rate quicker and quicker and quicker. So right now we're sitting around a 2.89%, 4.44% mortgage rate is what you can get right now as of today, 4.44, which is the lowest it's been in a very long time. And as you can see, we're hovering around the 1.55% mark here. So this is where I'm going to give you some really good advice, I believe. Um, right now, the spread is pretty good. I do not foresee the interest rates on the 5-year fix falling any further, unless the banks start getting really competitive and the lenders start getting really competitive with themselves. What I would highly recommend, if you need to buy at all, if you're looking at buying at all in the next 120 days, go ahead, talk to Frank Mortgages, and lock in a 120-day rate hold. The reason you want to lock in a 120-day rate hold at this rate, for example, is because if interest rates fall further, you can still get the lower interest rate product. You're never obligated to the rate hold that you're in. But what it does, it protects you. It guarantees you that rate if interest rates go up. So essentially, you're just hedging against interest rates increasing. So it's the best of both worlds. You put a pre-qualification in, you lock in the rate, rates go down, you get the lower rate. If rates go up, you still get this rate right here. And with the bond yield sitting at 1.55% right now, with the spread sitting around 1.55%, the bond yields have to drop essentially lower than they have been since, well, August, right? Um, and then, and if we're not just getting a precipitous drop in bond yields, I don't expect us to get a much better deal than we have right now. This looks like to be one of the best deals out there. And if you lock in, if it goes down further, you're fine. And if it goes up, well, you're fine again. So hopefully that explains what's going on. As you can see, the 5-year variable, not that attractive. It's 1.1% more than the fixed rate. Unless you feel like the Bank of Canada is just going to start dropping interest rates like crazy, definitely start looking at kind of a 1 to 2 year mortgage product. Slightly higher than the 5-year fix, but then you get the ability to renew your mortgage in 2 years, when most economists believe that interest rates will be a lot lower again. So there's definitely lots of options. I know it can sound complex, but hey, I do this every day and so does our team. If you ever need any help around this, just feel free to call us. We'll walk you all through it. We'll connect you with the right financial partner. We'll create a game plan for you and make sure that you're set for success. That's what we're here for. So feel free to call us. On the next part here, now we're going to flip into what's actually going on in the real estate market so you know what's happening. Okay, let's flip over to that. All right, so let's actually jump into the real estate market. So I've been saying for quite some time now that the real estate market is going to be staying flat, and I have been saying that interest rates could be dropping. It seems like I'm pretty much on the right track. I got some heat for saying that the market's stabilizing, but over the last 3 months, it's definitely been showing the trends of stabilization, and I feel very confident that I was right on that. And here, let's just jump into what's going on with the real estate market, and I'll let you be your own decision maker on it. Okay, so let's look at how much inventory we have and where we're sitting. So currently we have 157 homes for sale on the market in Guelph. The 5-year average is 176. So we're still below our 5-year averages. Out of those 157 homes, 22 are currently under contract. So there's a conditional offer to purchase them, meaning the net inventory that's available for anyone else to buy is around 135. Essentially, the buyers have to walk away from these 22 for them to be available for someone else to purchase. So really the net inventory that's actually available for new buyers is 135. Looking at the inventory mix, we're pretty stable. Everything is pretty close to the 5-year average. It's slightly down. We just did start February, so I'm believing mid-February we're probably going to catch up to these numbers. And here's your inventory view here. This gray line is where we're currently at, and the blue line and the green line are the last 2 years. So as you can see, we have a lot more inventory coming into the market than we have in the past 2 years, which is really great for stability and balance. Okay. Yeah, there's nothing really else to cover on that. It's pretty straightforward. If you have any questions about what's on the market and why does this matter, feel free to reach out. Okay, looking at listing inflow here. So in the month of January, we had a total of 158 properties coming into the market. And that is on average 5.1 homes per day. Okay, that's 28% lower than we usually get. So on the supply side, we're a little bit slow. However, on the sales side, we only sold 98 units, and our 5-year average is 136. So we're only selling about 3.2 homes a day, which compared to 4.4 homes a day on average is down 27%. Why did I highlight them yellow? I highlighted them yellow because they're almost in a perfect balance. 27%, 28% less homes came to market, but 27% almost 28% of homes less sold in the market. Pretty much is a perfect balance in, yeah, not a lot of sales, but the perfect amount of inventory came to the market for the current marketplace. So that's why we're seeing such a stability in the marketplace right now. As far as outflow failed, like I said in my previous video that I shot on the 18th of January, I really did believe that the most of the failed sales were at the beginning of the month, and it was just from like the end of the December cleanup, the end of the year cleanup, just all the homes failed to sell at the first week in January. And it looks like that held up to be true because we were sitting around 35, 40 homes failed to sell by the mid-month point, and we only really added another 15 homes failed to sell in the last second half of the month. So it really looks like the failed sales are slowing down as I thought they would, which is good because it just really just gets rid of all the stuff that's not serious, and now we just have great sellers on the market and we have good buyers on the market, and there's a nice balance going on right now. Um, okay, average days on market sold. So as you can see here, we crept all the way up to 30 days on market in November, and now we're all the way down to 28 days. So we've been shaving off some days here. Again, a nice steady days on market, nothing too crazy. And the average days on market in January over the last 5 years has been 19. So obviously slightly higher than our average, but as you can see, 2019 we had 30-day on average market, 2016 at 34 days. So this isn't uncommon or anything to be worried about. This is actually pretty normal. Sold list price to sale price ratio. Here we can see that when a home goes on the market for $100,000, right now we're getting 97.5%, so 97,500. And that's staying in alignment with what's happening in the market. So we dropped at the bottom, we were at 93.6%. That was the lowest. And ever since that 93.6% that we had in August, which was the worst month, we've been slowly climbing back steadily up, and now we've reached 97%. So this is the first month that we actually had a 7 in the report. So it looks like the positive trend is happening there as well. Monthly average sale price. All right, here we go. So I always like to point out a couple of things because I don't know when the last time you watched this video is. I don't know if you watch every single biweekly report. But what I always like to point out is 2017, we had a drop in the market from the peak to the trough. We dropped 18%. And then it took 34 months for that market to recover. So here we had our peak back in April, and we haven't hit our trough yet so far because January looks like we're actually we dropped 0.33% compared to December. So technically speaking, yes, the market is dropping still. So peak to trough, which is right now the new trough is January 2023. We have dropped a total of 27.1%. Okay, it's a lot of money, 271 grand. But the biggest drop occurred from April to November. April to November, the market dropped 26.6%. However, since November, and this is why I've been saying the market stabilized, since November, so November, December, January, market has only adjusted 0.58% down. So flat, essentially flat. We've been flat for the last 3 months. So that's what I'm seeing in the marketplace and where I'm seeing my stability. So all those lead indicators combined, 26% less units coming to the market, 26% less going out of the market. Average sale price over the last 3 months, 0.5% down. Days on market at 28 days. List price to sale price ratio going up to 97%. Those are all factors that are really showing us that there's not a crazy knife drop down in prices. And if you buy today, you're going to lose 27% in the next couple of months. I really do feel like we found that equilibrium point, and that's going to continue probably for the next 3 to 5 months. I'm believing and I'm predicting. It's always dangerous to predict, I guess, is that the Bank of Canada and other central banks probably over aggressively tighten to fight inflation. A lot of other people are feeling the same way, and we could potentially see our first interest rate drops midpoint 2023. And if inventory, which I've been saying also in the videos here, since inventory hasn't skyrocketed higher and we're just at our 5-year averages, as soon as interest rates come down, I really do believe it's going to accelerate the market price value up. So if you're a buyer, my advice is lock in for your rate hold, shop over the next 3 to 5 months. You should be in a stable market to purchase. But the last thing you want to do is kind of wait for interest rates to drop too much, because what will happen, which has happened in the past, prices accelerate faster than interest rates drop. So as interest rates are dropping, prices will start accelerating. And really, you don't have that great deal anymore. Just because you're getting cheap money doesn't make it better if you're buying a house that's way more expensive than if you just got a little bit more expensive money and bought the product, the house at a discount. I did shoot a video about why now is the best time to upgrade your home, and it goes all over that as well in there. So feel free to dig into that. All right, just moving on here. I'm going to show you quickly the balance in the market. So far this year, we brought 158 units to the market, 98 units sold, 50 failed to sell. So we added at just 10 units to the market. It's not that many units we added. Only 10 new, 10 extra pieces of inventory. Okay, so if we look forecast 30 days in the future, what's the absorption rate look like? Well, we have 157 homes on the market. We continue to get 5.1 homes to the market a day. That's 153 new homes. So that means in the next 30 days, there should be a total of 310 homes to consume. If we are still consuming properties and failing to sell properties at a clip of 4.8 homes a day, that's going to remove 143 properties out of the market and will leave us at the end of 30 days 167 units available. If 167 units are available and no new inventory at all comes to the market and our consumption rate stays the same, this is called absorption rate, how many months will the inventory last until all the homes are gone? So with that math being worked out, we have 1.16 months of inventory, and a really, really hot seller's market is about half a month of inventory, and a more balanced market is closer to the 1.52 months. So we're starting to teeter towards a seller's market again, which is pretty wild. And that's pretty much what I got for the market summary. To summarize, if you need any assistance, you're looking for some questions, you know where to reach out to. Zon Team, 5-star real estate experience guaranteed. Reach out to us. We're happy to help you. Thank you very much.